Now, I think Ben Graham would agree with me that risk is not volatility. I learned, Jim says I went to the Booth School. I wonder, in fact, whether I did go to the Booth School. I went to the University of Chicago Graduate School of Business, which became the Booth School 30 years later. So it's an existential question, but I don't know the answer. Anyway, at Chicago, at Wharton, when I went to Wharton in the early 60s, it was a very qualitative, non-theoretical upbringing. They said, here's a picture of the New York Stock Exchange, here's a picture of a stock certificate. If you want to get one of these, you go here. It was very nuts and bolts. And I would include Graham and Dodd under the category of nuts and bolts. And then I went to the University of Chicago, where they didn't have any nuts or bolts, and all they had was theory. And I learned that risk is volatility. That's what they teach there. I don't think it is volatility. I think that academics latched onto volatility because it fit their theories and it fit their formulas. And there are a lot of formulas that make use of volatility or standard deviation, whatever you want to call it. And if you don't use volatility, there's nothing else you can plug in to those formulas. So that may not be why they did it, but I think it was certainly an essential thing. People in the real world don't consider volatility as risk. I've never heard anybody at Oaktree say, well, I'm not going to buy it because its performance may be volatile. And you know, risk, they taught us about this line at Chicago, which goes like this. Risk, return on the vertical axis, return on the risk on the horizontal, and it slopes up to the right. Some people think that means risk investments pay more. I'll return to that subject later. But the point is, the relationship implies the existence of a risk premium, an increase in return per unit increase in risk. It only exists if people demand it. That's why risk premiums exist. But people say, I will not invest in venture capital to get the same return as treasuries. I now have to get more. And then, in theory, assets are priced to give more if they're riskier. And the point is, my point here is that people don't say, I'm going to demand a higher return because it may be volatile. And so that can't be the risk that matters. In fact, I think the risk is actually not machinable, is not subject to being inserted into these formulas. Only volatility can be quantified. Nothing can be substituted, but volatility isn't the useful measure of risk. What it is the probability of loss. That's risk. That's what people mean when they say risk. That's what people demand risk compensation to bear. It's also, however, it's also the risk of falling short. And this brings in another kind of risk. And when you start having multiple kinds of risk, then the world gets more complicated. And of course, the world is a complicated place. But many investors have a return requirement, and the ramifications of falling short can be significant. So the risk of missing out is another important risk. And if you have to face the risk of losing money and the risk of missing opportunity, then you have a complexity to deal with, which makes life really interesting. Risk is also, finally, the risk of being forced out at the bottom. And this is one of the greatest of all risks. Many investors claim to be long-term oriented and immune to fluctuations. But many, if they have a bad enough decline, lose confidence, maybe receive a margin call, maybe have their money withdrawn by their clients, and are forced to sell at the bottom. That is really the cardinal sin.